Ladies and gentlemen, please welcome Amy Glad, Senior Vice President of Pardee Homes and the 2013 Chair of the California Building Industry Association.
Good afternoon, and welcome to today's CEO Keynote Lunch. Moderating today's panel is John Burns, CEO of John Burns Real Estate Consulting. John is a 20-year veteran in real estate consulting and holds a degree in economics from Stanford University. Joining John on stage are three distinguished housing leaders: Ara Hovnanian, President and CEO of Hovnanian Enterprises. Ara joined the company in 1979 following completion of his joint undergraduate and graduate work at the Wharton School of Philadelphia, where he graduated summa cum laude with degrees in accounting, finance, and real estate. Jonathan Jaffe has been with Lennar since 1983. In 1996, after working in multiple roles in Lennar's Florida operations, Jonathan relocated to California to start Lennar's Western Region operations. He was named COO in 2004. And David Weekley, chairman of David Weekley Homes. David started his own home building company in 1976 at the age of 23. Now, over 35 years later, the company has sold more than 70,000 homes and expanded to 17 cities across the nation. Ladies and gentlemen, please join me in welcoming today's CEO panel.
Thanks. The market's back, so this is going to be the most upbeat CEO panel in a while. I think we got a little greedy and charged money for lunch, so there's a whole bunch of people outside trying to get in, so we've got a smaller audience than usual. But this is going to be a fun conversation. I wanted to start it off first really by congratulating all three gentlemen. I mean, what industry, any industry, can survive an 80% decline in volume and a 25 to 30% decline in price per unit and make it through? I mean, to manage yourself through this is just a phenomenal accomplishment. So I'll turn to Ara first, but the same question for all of you. Tell us how you did it, and what, including some of the tough decisions you had to make, and then if you had to do it over again, what decisions would you do differently?
Well, our company was founded by my late father over 50 years ago. So we've seen a lot of cycles and to a large extent did the same things we've had to do before. Sell land that you didn't really want to sell, let go great associates that you don't really want to do but you had to cut overhead, sell houses for lower prices than you ever dreamed, but had to keep inventory turning. So those things were pretty typical. Fortunately, given that we're a public company and have public access to long-term capital, we were able to very quickly pay off short-term debt. Within the first year of the downturn, we paid off 100% of the bank debt and really financed our company with long-term capital that gave us the breathing room to deal with the market changes, and that's worked for us. The thing I do differently next time around, there's no such thing as too much equity. I thought $1 of equity for $1 of borrowing was good. I think that's not conservative enough now. That I do differently and pay more attention to the metrics than we did. We all started convincing ourselves that we'd go on forever, and it never does.
That's interesting to hear that, and $1 of equity for $1 of debt, because that's certainly not what I hear in the private builder world. John?
Well, before you take me back to the pain of what we just went through or how we're going to deal with it next time, I just want to enjoy this for at least 10 seconds, and because we're back, and that's a good thing. But much like Ara, we all face a lot of tough decisions. I think very similar. Our company's been around since 1954, and I've lived through a lot of cycles. And we've always tried to manage our business as a balance sheet first company, with a real focus on the fact that we are a cyclical industry, and none of us are smart enough to know when the shoe drops that changes things. what that outside event might be. So I think that gave us the ability to withstand this extraordinary downturn, one like we've never seen before. And even though we had a very strong balance sheet going into it, it got stressed to its max. So I think to R's point, we have to find a way to be even stronger because you had no idea that it could get that bad. First time any of us have faced a national housing recession the way that we did, and so you have to think about how do you prepare for that. I think that to me the key for our success in dealing with it was just recognizing what it was as soon as possible. Since I think like we all sort of drank the Kool-Aid and it was an exuberant time. The key was to quickly recognize the times had changed, start selling land, start making the difficult decisions of cutting overhead so that you protect that balance sheet. So at the end of the day, that's what keeps your company alive and allows you to grow today and hire back those people and start preparing for this upcycle and then the eventual churn.
Just one follow. How did you manage the trades through that, and then how is that working out today?
We have a hand-in-glove relationship with trades. We can't build the homes without them. Right. They can't meet their cash flow without us. So it's just like dealing with our associates. You had to make some tough choices. For us, the tough choices was to really consolidate into some of the trades that had better balance sheets, like same kind of thinking, the ones that would be able to make it, and give them more business so they could have enough cash flow to make it through. That was very hard for those that didn't have that opportunity, and that's really unfortunate, but just same way of making tough decisions with our associates we cared a lot about. We had to make the same exact kind of decisions with the trades.
The reason I bring that up is that's a lot of who's in the audience here today, just kind of looking around a lot of the trades and service providers. So just having a good balance sheet for you heading in was part of their criteria to stick with Lennar. David?
Well, we've got a much different kind of company structure than either Hovnanian or Lennar, because we've kind of got a land-light model, and so it's easier to go through the downturns. We don't make as much money in the upside, but we don't lose as much in the downside. And we've been through these before, and so getting through this was very challenging. I mean, we had to lay off 1,000 people, which 2/3 of our workforce. So I don't want to diminish that at all, but where we lost maybe 5% of our net worth, if you average the publics, they might have lost 60 or 70% of their book equity. So it was a much different balance sheet kind of issue. Okay. So ours was much more operationally focused, and how do we, only stay in the good deals and cut back the bad deals and renegotiate with our developer partners and work with our trades, and how do we attempt to get profitable as quickly as possible. I think John said it properly. The biggest challenge is to go deep fast enough and realize that this isn't just a casual thing that you can wait on and hope things get better. I think that's something that we all lull ourselves into from time to time. And in terms of things I would do different next time, I think our land discipline really helped us. So I don't see a major structural change. But to me, the challenge for us right now is trying to find the land and the opportunities going forward is to maintain the discipline that we had in 2004, 5, and 6, because it's a pretty crazy place out there right now, and maintaining the allocation, the risk allocation. We've got a pretty sophisticated risk allocation model per city and per market we're in to ensure that we don't have too much risk in any individual market. But maintaining those disciplines is hard.
John, if I could add on to David's comment about reacting quick to the downturn, I think it's also true, and I see it in our industry, of needing to act quick to the upturn as well, right? It's another inflection point, and I think that it's easy to be reticent to cut as you go into downturn, but it's also very easy to be reticent to staff back up, make the spend that you need to do to recognize the upturn in the market. And to some degree, you're beat on the head so many times during a downturn, you get a little bit numb, and it's hard to recognize where is the market today. And so I think that same philosophy applies just at inflection points, either up or down in the cycle.
Well, let me ask all three of you then, how much is your payroll up? How many people is your headcount up, or percentage-wise from the bottom? Are you doing a lot of hiring, Era?
Well, we went from a peak of 7,000 people down to 1,400, and I think we're up around 1,700. But the environment created a need for efficiencies for all of us, and we found ways to be leaner and meaner. I think a key is to stay lean and mean as the cycle expands up.
Okay.
Just an example of that, every geography had its own service call center, so you'd have certain efficiencies, and let's say we had 20 people around the country just taking the calls. Today we handle it nationally with a third of the people. Hopefully, as we grow, the service call center might expand from 6 people to 8, but not from 6 to 18 again like we used to have. I think keeping some of the efficiencies is going to be critical this time around.
You've gone from 1,400 to 1,700, so that's 20% growth, and your unit count's probably up more than that.
Yes.
So, John?
Yeah, we've grown about 25% in terms of headcount from 4,000 to 5,000, where we are right now. Some of that is in other businesses we've developed as well during the downturn. But I think ours, right, I think we're all much smarter. We had to be to survive, and so
I didn't say I was smart.
I said smarter, and that doesn't make us smart. It's still a low IQ business, that's why we love it so much, but we're smarter, and I think we have to maintain some of that edge. While still, we need more construction managers, more new home consultants, more people to run the business as our volume grows, and but the key is just you have to invest in some of the things you would cut back completely before, while taking advantages of the kind of efficiencies that Ara pointed out.
And I know David Weekley has won awards as one of the best places to work in all industries, right? So it's a real people culture there. So
So there's nothing like being the best place to work 7 times in Fortune and laying off 1,000 people.
yeah, it's going to be a while before you're on that list.
Yeah, well, I wouldn't be too sure.
Okay, good.
We're working on that. But we got down to 600 people and we're back up to 1,000, so we've added a lot more. And
60% growth.
And we have, we talked about inflection on the way up. We started expanding pretty early and have expanded into Phoenix and Indy and Salt Lake City now and looking at other markets. So we're ramping up relatively quickly because we see a great opportunity out in front of us.
Yeah, some people were asking me, what's David Weekley doing here? So I was scratching my head going, maybe they're coming to California, we'll see.
This takes too much money to play in California.
Well, that's a good segue into my next question. I'll let John go first on this one, so everybody's got a chance to go first. What are you seeing in the land market today, and how is that dynamic changing?
Well, we're certainly a lot more attractive to land sellers today than we were, 3, 4, 5 years ago. The land market's moving really fast. You put out data, John, that shows how much it's recovered from the trough, and we all know in some markets it's already back to pricing that was sort of 06 pricing. Some markets not yet. There's a real lack of finished, entitled home sites for builders to build on. So you have a real imbalance between supply and demand. It's driving land prices up, just like you have an imbalance with housing inventory, right? That's driving home prices up. And so land's accelerating, and it's, during the downturn, we all picked up the, finished home sites in A locations. We've churned through those. And now an industry that wasn't developing any land for 5 years is suddenly trying to crank itself back up. But unlike any other manufacturer, we can't just flip the switch and suddenly have home sites tomorrow. So you're going to have this imbalance, I think, for probably the next year in front of us till the land development industry catches up.
And other than 5 Point, which I know is its own animal, are you doing more land development now? And is that part of the staffing
absolutely.
up that you're doing?
Yes.
What are you seeing in the land market, David? And I'll just add an interesting anecdote. We just put out our builder survey this morning. And one of the questions we asked this month was, how tight do you see the land market? And it was the Texas guys that were complaining about tight land more than any other group. And I told my staff, we are not putting out that the land market is tight in Texas. Okay. So tell me what's going on in Texas, and maybe that'll compare and contrast it with the rest.
Maybe we just like to complain more in Texas.
Yeah, maybe.
Yeah, maybe we just whine more.
Maybe you actually have to look for more than a couple hours.
Right. No, even though Texas is big and wide open, land is still a challenge, and A locations are still a challenge. We've increased our land departments. We've never had big, heavy land departments, but we're adding staff. We probably tripled or quadrupled our land staff.
Okay.
As a company. We're having to do more development-like work than we've ever done before. We're having to put more equity in than we've ever done before. So this land risk, when I say how do we maintain the disciplines that got us through the downturn without losing it now that we're out there trying to grow substantially is a real challenge. And internally we argue back and forth a lot
Right.
about what to do and where to go and how to partner with this guy and how to finance this operation. I think all of us have gotten to be a lot more adept at land finance, or at least our company has. These guys were probably adept long ago, but we've become a lot more adept at land finance than we ever were before.
Now, Era, I know you've announced you're doing some land banking deals and things too, so why don't you share with us what you're seeing in the land market and how you're structuring your deals?
Well, like everybody has seen, the land market's gotten very tight. Fortunately, it's generally pretty rational. So home prices have gone up, land prices have gone up commensurate with it. It can be choppy. There are places where the land prices have shot up ahead of where the home prices are. Places where home prices have gone up and land hasn't quite caught up, and there are opportunities and imbalances all over the marketplace. We did do actually 2 transactions with GSO Blackstone and a land banking arrangement. It allows us to synthesize a land light model that David operates under. By the way, we accidentally did a land light model. We had a land heavy model and took lots of impairments and ended up with a land light model.
Still a lot of lots, but not a lot of balance sheet.
Right, exactly. But we think, we have to do the most we can with the capital we have and trying to maximize that. And a land light model through land banking is one of the ways to do that. But we purchase land in every fashion imaginable. We'll buy land that's fully improved. We'll buy land that's raw and improve it. We'll buy land and through a land banker. We'll buy land through developers in Texas, where you can put a Starbucks latte down as a deposit, and that's why they're all complaining now. They want a full double venti cappuccino, and it's a problem. But we're flexible, and we have to be.
Can you give a 20 to 30 second overview of land banking for everyone? Because we've got a diversified audience here.
Well, I mean, essentially, instead of buying the parcel directly, a land investor buys the land. We put a deposit down, and that typically in the market is between 10 and 20%, and we buy lots on a quarterly takedown.
So it doesn't use up a lot of your capital, but you've got access to the land.
Yeah. But they need a 15 or 20% return instead of a bank 4% or the return requirements are higher.
Higher than a bank. Not as high as 15 to 20%, but
we'll talk
higher
later.
than a bank. For sure.
Yeah, there's some folks from GSO that'll like to talk.
Right.
Now, since you brought up the structure, now Lennar had a lot of JVs heading into this downturn. Are you back doing joint ventures again, or are you buying it on your balance sheet, or what's the strategy?
We're primarily buying on the balance sheet. In select cases, we're doing a joint venture with a like-kind partner, so another big builder. Where there might be too many home sites and to split them up. We're doing some with David in Texas as an example, which I just learned about talking to him earlier. But
okay.
But we got very heavy into the joint venture model as a way of diversifying risk. What we learned through the downturn was that if you didn't have a partner that had a similar balance sheet, you took on a different kind of risk and exposure. And so a lot of brain damage in working through those. I still believe they diversified risk effectively, but it's not worth all the effort and brain damage. So we're not looking to get back into that model again.
Yeah. So let's switch topics then, and we'll start with David and then go to Era. Let's go to the home buyer. So how is today's home buyer or consumer different than, say, 10 years ago, and how has your product changed, your designs changed to meet the demand, if different?
Well, the good news is most of us recognize that our primary competitor was not each other, but was the resale home over the last, 4 or 5 years. And so most of us, or at least we, went into a pretty significant green program and initiative. And I made that move especially when I found out that I could put in $3,000 or $4,000 more worth of energy savings components and immediately get a payback. In other words, their monthly payment, if you took the increase in house price and the deduction in energy cost, they would come out less from day one. So this was not a 5-year payback or 3-year payback. It's an immediate payback for what we figured out we could do.
We're still trying to work on that with the LBA to get that into the appraisal, to get them to consider that, right?
Correct, but it worked out well. In addition, you know, I think we're doing a better job as an industry designing homes the way people want to live. A lot more single dining plans, a lot more open plans, you know, command centers and kitchens or office studies, and just a whole variety of things which bring the houses into different kind of formats, floor plans, and places than the home that they're moving from 10 years ago.
So more technology, maybe more space that gets used all the time versus
Right.
space that only gets used occasionally.
Right.
Yeah, in general, I'd say there's almost been more home design change in the last 5 years than any 5-year period I can remember. Like some of the trends David's talking about, you know, a lot more emphasis on the great room. In fact, the living room is slowly dying a death in favor of a study that's more practical and usable. Kitchen islands are on steroids and just growing every day. Garages are as big as houses used to be. It was just no limit. You know, 2 cars turned to 3 cars, turned to 4 cars, and oversized cars. In general, and this is certainly helped by the rates, homes, there is definitely a niche for larger and larger homes than we ever dreamed would be logical. And a trend that probably Lennar pioneered and really drove to the market better than anyone is this idea of a multi-generational house where you could have a different family member, you know, older or younger. That's been an interesting design trend that many are seeing. Many are supplying. Lennar was clearly the first, and it was a great execution, and others are following, and I think there's a lot of interest on the buyer's side, too.
So more square footage, bigger garages, the exact opposite of what you read a lot in the paper and Sarah Suzanka and all those sorts of things.
Yeah, well, in the beginning of the slowdown, the houses shrunk, and the amenities shrunk. It was the complete opposite. And then as rates came down, it was an opportunity for monthly payments that they were within everybody's range. All of a sudden, people could buy 3,000, 4,000 square foot homes that they never dreamed they'd be able to do. And so the houses.
Some of this induced by the Fed.
It helped spur it, and that was their intention, I think, to help spark the economy through helping housing get back on track.
So he mentioned the multi-gen that you're working on. I know you guys had or maybe even still have some R&D labs where you've been testing various construction techniques.
R&D fell by the wayside during the downturn.
Okay.
There wasn't the dollars for that. But during the downturn, we did focus on multi-generational housing and our next-gen product. And you know, our team in the West, led by Jeff Roos, I think really took a leadership role in trying to figure out how to do that well. What wasn't the existing housing stock providing? As David said earlier, we really don't compete as much against each other as we do existing homes. And if you think about it, there just isn't multifamily opportunities from somebody in the existing housing stock, including the stock that we use, you know, where new homes are now existing homes. For builders, you know, master bedroom down was multi-generational. That's as far as we went. So we went the extra mile, and we've, you know, created this suite concept that's part of the home but separate entry, which all our research showed was a real important feature for privacy, for respect of that privacy, and so that it could be separated from the home, but yet an adjoining door, just like an adjoining hotel room, where they easily are part of the family. And you know, I would say that one of the things that is probably, I don't know if we expected it, but probably the nicest thing in what we hear really resonates with today's consumer is, I think this downturn has focused everybody back on family to some degree, and what's more important to them in life, because it just brings things into clear focus. And grandparents spending time with grandchildren and getting those special moments that otherwise they wouldn't capture is something we hear is very powerful. And so we are developing a lot of new designs for next gen to roll out with, you know, maybe even an extra bedroom. So for larger families, maybe for more ethnic families that want naturally be together. And I think this is going to be a trend. As Ara said, all the builders are sort of jumping on that bandwagon. And I think that our industry is going to do a much better job of serving it. Part of the good thing for all of us involved in the industry, it does mean a slightly larger home, so there's going to be more square footage, more materials that go into it, more labor. So I think it's going to be a good thing for all of us, and it's going to appeal to the largest growing demographic in the country, right? As the baby boomers age, and their children have to figure out how do they help support them from a health standpoint, financial standpoint. I think you're going to see it'd be a big part of the builder's repertoire as we go forward.
This is part of the deal. Mom and dad show up with a down payment, and the kids take the mortgage payment.
Well, we're seeing that sharing the payments. It's during these times where there's still a somewhat weak job market out there. We're seeing a lot of people combine payments or down payments in various ways to make that happen. So it makes housing something, especially with today's low rates, something more affordable to people that otherwise couldn't, and especially where the mortgage funnel is still constricted, right, with all the headwinds, and the pendulum swung too far and hasn't moved back to norm yet. So it's helping people who really are trapped outside of the opportunity to buy a home, team up with family members and buy a home.
How about the active adult buyer? Have you seen, are they coming back, and is the product that they're asking for different, or is it similar? What do you say?
I mean, that market has come back similar to the general market, I'd say. And we're seeing some similar trends in the houses are just getting larger.
Okay.
I think that almost feels like that market's come back stronger. Not that it's bigger, but it was completely gone.
Yeah.
Right? During the downturn, you just couldn't sell to that consumer profile. The fixed income was destroyed. They lost a lot of their equity. They lost their income stream. And so it feels a lot healthier today, but it's still, just like all the other market segments, at historically low levels of demand as we're going from unheard of low levels back to something normal. But it's definitely recovering.
And John, I see a real opportunity. We do about 6% of our business in mass planned communities. And as compared with the kind of historical vision of a separate retiree community kind of all on its own, a la the Villages in Florida or Sun City or whatever, I'm not sure that our generation is going to go move to one of those kind of environments as compared with into a master plan community where you can have multiple builders, multiple product lines, et cetera. The deal I was telling John about in Cinco Ranch in Houston was where we and Lennar went in together, and they took the 45-foot patio lots, and we split the 55s, and then we took the 65s, and so we're in there together. We built the rec center, so they have product diversity. They're within a master plan community. Their kids can live a community down the road. They have a gated entry, and I think that there's a ton of opportunity in approaching active adult in a different way, in a different flavor, ways that I could really see Ara moving into.
Yeah.
Let me get my iPhone out. Hold on here.
Well, Rancho Mission Viejo, an hour north of us, is going to do 8,000 units of those. So we'll see how that works out. So there's 3 concurrent forums going on today. We have consumer, land, and so I've asked those 2 questions. Now I want to move to the capital markets, and I'll start with you, Ara. Tell us what's going on in the capital markets from both a debt and an equity standpoint. I know all 3 of you have tapped into the debt markets lately, and even share what some of the pros and cons are with having to deal with that.
Well, the pros are capital is available in the public markets, much more so, I assume, than the commercial banks, which have retrenched a lot more. We actually did our first public bond offering back in 1981 when we were still private, and have had a long track record with bond investors, which really helped us because I mentioned earlier that we paid off our bank financing and we're 100% relying on on bond financing. It was long-term money, but it had a maturity ladder that staggered over a number of years. Some maturities were coming due in the next year or 2 years or 3 years, and fortunately, even in the depths of the recession, we were able to go out into the market, again, I think because we had a pretty good track record, in spite of the balance sheet, which is not what it used to be. We were able to go out and do, last year, we did close to $1 billion of refinancing, bought back some of our old debt, and refinanced out longer-term debt out with maturities 2020, 2021. That gave us a lot of runway to deal with the recovery.
So eight-year maturities, what's the interest rate on something like that?
Oh, it varies. Some of it, we had different layers and different tranches. Some of it, less than 5%. Some of it over 10%. Just kind of varied on when we issued it and what layer of risk.
So 5 to 10%, but unlike a private builder, it's not something you can draw down when you need it. You raise it, you've got it all, and then you need to go invest it. Can you talk a little bit?
Well, yeah, and that has cost implications. Because of that, unlike when we operated with a revolving line of credit that you manage your cash down to a zero balance, we actually manage our cash. We'd like to keep it as low as 175 million. We've actually ended the last few quarters closer to 300 million, which means we're a little underinvested. But leaving that much money on your balance sheet is expensive. We pay a lot of money on the debt side, and to have it sit there is costly. On the other hand, you need to have dry powder. We don't know where this market's going to go. There's a problem in Iran or Syria or God knows where, and the market takes a breather. You've got to have sufficient liquidity to get through that period. So we operate with excess cash. Ultimately, we will get back to a position where we don't do that and we use a revolving line of credit. But at the moment, this is the most logical way for us to operate.
John, you guys probably do as much or done more in the capital markets than anybody. And then in the private markets too, you've structured a lot with your joint ventures and things. Can you give us some color on comparing and contrasting the public and the private?
Sure. Well, the big thing is ours. It's available and it's cheap right now. So, for example, I think it was like 2008, we did a bond offering at the worst time, but to shore up our balance sheet, make sure we could survive. Our rate was over 12%. So this past year, we've done it with 4% to 5% kind of pricing.
12% to 4%.
Big difference. Wow. The other thing the availability allows us to do is really stagger the different bond issuances we have, so that the maturity dates are staggered between next year and 10, 12 years out, so that we won't be under pressure in any one year from a standpoint of what gets repaid. We've also accessed that market and done a lot of convertible debt offerings. So for example, we have one coming due in our first quarter next year. There's no question it will convert into equity, so we're not going to have to pay that debt back, which will mean we really borrow that money at, say, 2%. And it also frees up more capacity between the debt-equity ratio on our balance sheet. So that's a really constructive thing that we do in terms of managing our balance sheet. Public-private, just two different worlds. So one of the really nice things about the public debt market is the covenants are very limited. So there aren't a lot of restrictions on you. As you said, you get the money, you really choose how to invest it. It's unlike a bank line with draws or lots of other covenants, borrowing-based covenants, et cetera. You don't have those restrictions. So if you can access that market, it's available, it's cheap, light in covenant. So all positives. Joint venture financing tends to be more restrictive because it's project financing, so it's going to be more related to a percentage of cost to complete or an LTV, and then covenants about what ratios you can go to. So it's a smart vehicle to lever a long-term land joint venture, but it's clearly not as flexible or desirable as the public debt. But that venture can't go out and access the public debt markets.
David?
Yeah, we try to live between both worlds. We've really enjoyed a great banking relationship for the last 35 years, and we're always able to borrow money when we needed it. And part of it was the matching of debt to the time frame we needed debt. Right. And we had short-term liabilities with home building, not longer-term land. And so there wasn't a need for us to go get longer-term debt. So in the depths of the downturn, we had paid back basically all of our debt because we didn't have land and we were just internally financing our house construction. So we went from $400 million in debt down to zero, and obviously had zero interest cost for a year or two. And then coming out of this, the banks were still there and wanting to loan money because, again, we're not doing that risky land stuff. We're building houses. And so, but recently, the market was such that it was kind of too good to be true. So we went out to the public markets and did what's called a private 144A financing, which means we don't have to make SEC filings. We don't have to do those things. But we were able to get $200 million worth of funds for a 10-year period at a 6% coupon. We had to go get rated as a company, just like the big boys. And so, you know, we went to Moody's and they rated us, and we ended up kind of being a rating with some of the publics. And so it was a good experience for us. We did it in January, and it worked out. But we also set it up in a way to where we can grow our bank financing behind it. So this financing is unsecured. It's not project-based or home-based, but we can grow secured financing kind of in front of it up to $500 million and then up above that. So we just see it as a tranche in this capital structure. But the reality is, if we went down to and had another crash like we did last time, we'd still have to pay at 6% on that $200 million. So we'd have $12 million worth of interest carry regardless of whether we needed it or not. So we try to balance those two. And we do manage our balance sheet down to zero cash because we don't need it. It's just there to draw whenever we need it from the bank. So we don't have that excess interest cost. And we also don't have any excess cash that's kind of driving us to maybe go to a land deal, or how do I go use the money, or, you know, I don't know how much of our land fever right now is based upon the fact that the big boys have billions of dollars sitting on their balance sheet that they're paying interest on. I mean, I don't know if that drives you guys or not, but it's...
Oh, we like having billions of dollars on our balance sheet. It's not a bad
problem
thing.
to have.
It'd be nice to have, I guess. But you got to pay for it.
There are worse things.
Right.
Just so you don't ever call me a liar, John, I've really been responding to your question from the single-family for-sale home building side. So that's my day job. And my night job, where we do multifamily, we bring in partners. So those are all done in ventures. So I'm not lying to you about our venture business.
I was going to ask you about that, though.
And we do bring in project financing, which is typically 60% financing on the acquisition development cost of the project. So those are financed very differently than our for-sale communities.
So you've done some very different things structurally for the company. You took I think it was five huge master plans, and they're called 5 Point, and that's got its own capital structure, I presume.
Right.
I'm not sure everybody in the room knows, but you've announced you're doing $1 billion worth of apartment development now too. Is that
well,
big
annually,
number?
Yes.
Per year. Is that to build and sell, or is that to build and hold? And the reason I ask that is a lot of the private builders that made it through this cycle had huge income portfolios that they were able to rely on as things got brutal.
Yeah. We didn't enter that business as a hedge against for-sale business. We think that that's a real viable business, that the demographics support growth in both multifamily housing as well as for-sale housing. And so we manage that separately as a distinct profit center, and believe that there's a very attractive business model that we can grow there. Our desire is not to be a merchant builder and build and sell, but to really develop a platform and look more long-term. But we'll be opportunistic and evaluate those decisions as we have choices to make.
And then on top of all that, you went out and raised some funds to do Rialto. Can you share with us how that capital structure worked?
Sure. Rialto is started as a distressed debt business. For those of you who knew us when we spun off Lennar, it's really an Lennar redo. Went out and executed on a couple of very large portfolios with the FDIC, acquiring their distressed debt in a partnership with them. And
so
then
they bought the loans, not the real estate.
Correct. We bought the loans that were failed loans. And then we go and collect or foreclose on the properties and earn money that way. We also have raised some private funds for that business. Our first one was about $1 billion. That all got invested and is producing returns for those investors. We're in the middle of raising our second fund right now, with an eye towards that distressed debt business being a special servicer in the commercial mortgage security-backed business, as well as in the commercial business.
Great. So finally, I wanted to wrap it up here with everybody in this room. When you look around, there's a lot of executives in the room is running some sort of business or an executive in some sort of business in the industry. And you mentioned earlier, John, about it being important to forget sometimes what happened, not to forget, but to believe that we're in a big recovery here. What's each of your outlook for the next 3 years? And what would you advise everyone in the room to do? How aggressive should they be in growing their business, for example? I'll start with Aaron, we'll work our way down.
Well, I'm pretty convinced we're early in the recovery. I've chatted about this. We actually had our quarterly conference call, analyst conference call this morning, and I reviewed some of the stats. Just in terms of overall housing production, the average has been between 1.4 and 1.5 million per year. We're all the way up now. Oh, and by the way, the post-war low was 1 million starts. We're all the way up to a run rate of 850,000 starts right now. So it feels fabulous. And if it was at any other time, though, than this current part of the cycle, it would be the worst devastating level of housing we've ever seen before. And by the way, demographics say we should be producing more this decade just because of household formations than 5 of the last 6 decades. So, you know, when projected housing should be 1.6 to 1.9 million starts per year, including apartments, and we're currently at an 850,000 run rate, I think there is still a lot of runway ahead. So I'd say as aggressive as anyone's balance sheet would prudently allow them to expand, I think would be a sensible thing to do.
Still stick with the $1 equity, $1 a debt?
No, that was our old ratio. That was not conservative enough. Okay. We're more leveraged than that right now, but my goal would be to be more than $1 of equity long-term than to $1 of debt in the future. It just may take us a couple of years to get there.
And since you brought up the supply constraints, I'll just ask you, I mentioned to David at lunch, they're building more homes in Houston than we're building the entire state of California right now. Where are you seeing the problems in getting back to that 1.5 million units since you run such a national business?
Lennar is more national than we are. David's as national, I think, today. But I mean, the hot markets, Texas is actually a very big market for us, Houston and Dallas. The hot markets in terms of appreciation, I think most people have seen in Northern California, Southern California, Phoenix, and throughout several of the Florida markets.
Now, is that due to supply constraints?
That is clearly one of the factors. There's in those markets, even in Phoenix, in the better locations, but in California, even in the B locations, it's just much more constricted supply.
John, what's your outlook and what's your advice to everybody?
Well, my outlook's very positive, and I think that we have a fundamentally sound recovery happening. I think inherent in your question is, well, what about the people that say it's a bubble, or what about the people that say rising interest rates are going to slow things down, or what can go wrong? Because otherwise, everything seems really good and rosy, right? I think Ara hit the nail on the head, which is we're coming from such depressed levels that we're not even back to something that anyone could call normal. And so you're going to have the pundits out there that look at what may seem like an erratic move, say, oh my God, housing just went up 10% and average sales price, that it's a bubble, or rates move 50 bips, it's going to kill everything. I think that's just the desire for someone to have an opinion about something. Right. I don't think there's anything fundamental about that, because we have a long way to go. If you look at every market across the country, one of the metrics I look at is where's permit activity now, and where is it related to sort of an average, and where is it related to a peak? And I'd say on average, most markets are 50% of a normal level. Mm-hmm. Some are a little bit more than that, some a little bit less. So we've got a long way to go before I think you can talk about excess or bubble or any of those kinds of things. And I think we have a long way to go before interest rates affect that fundamental demand that's there. We're at historically high levels of affordability, and so there's a lot of that can be eaten up before people find it difficult to afford to buy a home. And I think in some ways the fact that we do have some headwinds actually is keeping it in check, even though it feels like prices are moving pretty fast. If mortgages were free-flowing right now, prices would be spiking even faster. But what we do see happening is some loosening in that you see some private mortgage insurance companies getting in the game, right? And so you're starting to see the funnel widen. So for every buyer that might fall out because rates go up 50 or 100 bips, I think there's a buyer that's coming in that couldn't get a mortgage before. As well as, if you think about it practically, as rates go up, why are they going to go up? Well, primarily they're going to go up because the economy is getting better, jobs are getting stronger. If not, I think the Fed's going to continue to influence rates down. So I think that coincides with more people having the ability to afford and desire to buy a home. So I think fundamentally very strong. And that's why I said earlier, I think there are still a lot of people that are going, is this a false start? Do I need to be concerned? Well, there's always the black swan event of, Iran launching nukes tomorrow on Israel or something like that. And so you have to have a strong balance sheet and eye towards that as you grow. But I think anyone that's not growing right now, it's sort of like anyone that's not buying a home right now. You're going to regret not doing it, right? Because prices and interest rates, that combination is never going to be better than it is today.
John, I'm going to change my answer because I just remembered there are competing home builders here. I see dark clouds on the horizon. I think everybody should sell their land, not buy any land for the
Well, I remember these panels in 04 and 05 were about you trying to buy some of these guys. So I don't know.
I think our bigger challenge is people.
Yeah.
I think that in the last 6 years, a lot of people permanently left our industry. And the thing that I would advise everyone is go out and start recruiting college graduates, start training them, start mentoring them, start figuring out who are the people. So you're not just grabbing, people and putting butts in the seat because there's a job to do, but starting to think ahead about as you grow, how do you take advantage of the efficiencies that are talked about earlier and be leaner, but you're still going to need more people, and they're not there. So how do you train people? How do you grow people? And I think I would say it's a place that probably this group, and whether it's builders, trades, suppliers, lenders, anybody, we're all sort of slow to hire and to train and think about that. And that's one place I think we have to invest, or else we're going to find ourselves growing faster than we have the ability to support it. We're going to make mistakes that are costly.
I'll echo that. I did the math the other day. We've hired 17 people in the last 12 months. The talent that out there is unbelievable, and we are the optimistic industry when they look at what industries they want to be in. So it's a pretty good time. David?
Yeah, I don't have a lot to add. I mean, I'm very encouraged as well. What I would say is, as I look forward, is that I always try to operate whereby if something happens, right, where all of a sudden we start inflating our way out, or there's some shock, that I'd never want to bet the company on any particular land deal, particular strategy, particular this, but particular that, because I cannot predict the future. None of us can.
Right.
It looks good, it feels good, it smells good, but at the same time, we know, I can't tell you where the next downturn is going to be 3 years or 6 years or 10 years. And I remember coming to PCBC and being on a panel with General Lyon and Ray Watt in '89. And the story then was that this was California. It could never go down. You had the Japanese influence. You guys from Texas just went through a downturn. It was like I was the naysayer, and here were the two icons saying, go home, kid. You don't get it. And then a year later, I get a phone call and said, you were right. I guess California is, part of the rest of the world. And so we don't know what the future will bring. I'm encouraged. We've got a growth plan. We call our Noble Journey now through 2025 to grow from $1 billion company to a $5 billion company. We talked about the cities we've expanded to. So we're very encouraged, but we're maintaining the discipline not to go bet the company on any expansion move. So it's maintaining that discipline because we don't know what tomorrow will bring.
So obviously that plan will change as things change, but how did you decide to grow 500% over the next 12 years? Where did that?
It was a great number.
Okay.
It caught some vision and some excitement, and if we miss it by $1 billion and it's only $4 billion, that won't be that bad a deal.
Or if you miss it by $1.6 billion, that won't be
right. And so it kind of resonated when I'm out talking to the team.
Okay.
Got people excited. We're talking about adding people. You want to get people excited. Talk about growth and opportunity, and everybody in the company's got a management opportunity, and there's a lot to get excited about. So coming out of this downturn, talk about possibility thinking rather than being hunkered down, because we'd all been beat up.
Right.
You know, they say a leader's job is to define reality and give hope. That's really the best definition of a leader that I've heard. Define reality and give hope. And it worked for us all through the downturn to be very honest with people, talk to them about what we were going through, but that we were going to make it through. And now, from where we are, to define reality about the opportunities that we have as a company and the hope that we can become a $5 billion company within a time period by being, you know, projecting things, having a strategic land plan and a strategic people plan with opportunities for people. It's an exciting time to be in our business.
Aaron, John, do you want to share your growth outlooks for your companies?
Yes. Definitely. I mean, it feels great to be growing again. We are actively looking for land acquisition and growth opportunities in every single one of our markets. We think almost every market's underserved, and we think there are opportunities out there. I like a round number. 5 billion sounds like a good number.
How do you define underserved?
Well, if household formations plus obsolescence plus a little second home demand adds up to X, and the markets are currently producing 0.5X, then it's underserved.
Does that market need another builder, or are those builders in those markets going to double in size and meet the demand?
We are, unlike David, we're primarily focused on internal growth in the markets where we are. We're in 19 states. You know, we're far from the #1 builder in every market, so we think there's a lot of opportunity. That being said, we did have good success in acquiring and helping other builders team up and grow with us. We didn't do it always at the right time. We certainly did some transactions within like 17 minutes of the peak of the market. I'll try not to repeat that. But you know, we had a good experience, and a lot of the senior management and even the owners are still with us today. So you know, if the right opportunity presented itself, we'd look at that. But our primary focus is internal.
John?
I said I think virtually every market is underserved, and what it needs is more developed land, and that, as I said earlier, is just going to take time. I think you have actually, in addition to the pent-up demand of household formation that's been not been satisfied over the past 5 years, I think you're actually going to have some variables that create greater household formation as we look forward to give even more growth opportunities. I think you have more wealthy immigrant buyers today than ever before, particularly from places like China. And if you're in California, I mean, you see it. You have Chinese buyers. You didn't have that before. This will sound weird, but during the downturn, the divorce rate went down because people couldn't afford to get divorced. It's now started back up, and divorce is our household formation. I hate to say it, but you're going to get it from that. And then you just have population growth, which is still occurring. So I think you're going to have greater demand, and again, our levels of supply create an underserved market in every situation. We have growth plans, but you know, it's not that there's some. We have all different variables. So we look at a 5-year plan and we say, okay, what is it at this level, that level? What does it look like? What does our balance sheet need to be to support each of those levels? And it's more of a nimble exercise for us where we're constantly adjusting and tweaking it versus saying, this is where we want to be. Because I feel like you can make a mistake if you are just driven to that point. So you know, this year we'll probably grow close to maybe 50%. Over last year, and that's just because that's the reality of the marketplace and our ability to access that market. And
so you're going to grow 50%.
We'll just stay nimble.
And your staffing's up 20%. So yeah. The need for more people. I did leave a couple minutes here. If somebody had a question, it's hard for me to see. But does anybody have a burning question they want to ask one of the CEOs? Yes, right here.
They'll go up.
Yes.
The question was, what's going to happen to interest rates? Okay, they'll go up.
You got to ask Bernanke. I don't know. They're not going to go down. And you know.
Well, let me ask the follow-on question: how do you protect yourself from them going up, or does it matter?
As I said earlier, I think that the market can withstand interest rates. I don't think that they're going to go up 300 basis points. I think, you know, if we saw that coming, you'd react a little bit differently, perhaps in the amount of inventory that you had in the ground. So
you'd have all three of you would have a huge competitive advantage with long-term fixed rate debt.
Well, the question is, how is it going to affect the buyers, right? In terms of our balance sheets, yeah, we're well positioned, but will it affect the buyers? I don't see 50, 100, 150, 200 basis points affecting the buyer today. And so rates just went up a little bit, right? So just like these guys, you know, on our weekly call with all of our operators, it's what did you see? How did it affect anything in the field, front lines, current market? And no, we did better in every market this week than we did the week before. So just stay really close to it, and I think we'll all be very sensitive to adjusting our inventory levels if we start seeing something affect the consumer demand. But I don't think any of us are smart enough to know how much they're going to go up, except Ari, he might be. But Dave and I know we're not. And, but we all, I think, are smart enough to say they're definitely going to go up. And it's a question of when and how fast.
John, one of the things I track, and I mentioned this on our conference call. I mentioned it. Robbie Whalen is somewhere in here from the Wall Street Journal this morning. We was chatting about it. It's the affordability index, which tracks median family income and compares it to the income necessary to afford a median-priced house. Right now, it's higher than it's ever been. It's 190. The median family has 191% of the income they need to buy a median-priced house on average, and nationally. Different right here, a little better in California, in Texas, but it's a good general barometer. If mortgage rates went up 275 basis points, that index would fall to about 138. That's a big drop from 191, but it's still actually one of the highest levels we've seen in the last 30 years. So there's room right now. If you combine much higher rates with much higher home prices, then affordability could deteriorate a little faster. But it's something to keep track of and something we're watching closely.
Yeah, our math was that mortgage rates could go all the way to 7%. Our home prices would have to go up another 30% just to get back to normal affordability nationally. Those numbers are smaller in California, but they're still substantial.
That's the point. There's just a lot of room between where we are, where we're coming from, and where we currently are before you're in anything you'd call normal. And I think once you start getting to normal, you have to reassess, you know, are the fundamentals there to drive it past normal, or is it going to, you know, start rationalizing around normal?
Right. Okay, well, everybody please join me in giving our panel here a great round of applause. That was fantastic insight that we'll all use in our business. So thank you very much.
Thanks, everyone.
That was great. Thank you.